Welcome to the daily update, where I'll go over the action in the market for Friday, February 2nd, and then we'll see how things look for Monday, February 5th. We had a pretty solid up day. Unfortunately, it was just a handful of stocks that really led things higher. We saw the mid caps and the small caps under pressure. The Dow wasn't doing all that well. It was mostly the S&P 500 and the NASDAQ 100. And a lot of that had to do with Meta or Facebook earnings coming out, which then bled over into other companies like Nvidia. They were also up. Microsoft had a pretty good day. Amazon had a pretty good day. So when you take all of that together, it's the Magnificent Seven that are really driving things higher. That's fine when you focus on the S&P 500 like I do and the program that I teach. But if you're investing in other stocks, you probably had a fairly frustrating day. So let's go back and talk about what happened. Right at the open, we did have a gap higher open and prices climbed above R1 at 49.25. We also got up to R2 at 49.42. Now, that was pretty much a surprise because the employment situation report ended up being just astronomically stronger than what the market had been anticipating. So to see the futures really fall before the market opened and then come back up, gap higher, and then go higher after that was a bit surprising. But as I said, it was mainly due to just a handful of stocks. Then, as the day went on, we chopped higher with prices. We hit resistance at 49.75, another round number, and then we came down off of that, but we did close off of the high. We were up 1.07% on above average volume. The technicals were positive, but we're starting to see some real negative divergences here. Things that we need to be aware of. We have to follow price. That's number one. And as long as price keeps going up, all the perma bears and the doom and gloomers, they can scream all they want. But until price actually starts coming down, we have to go with price. We still want to be aware of these negative things that could be developing a little bit under the surface, especially in the S&P 500. And it's about inflation and interest rates. Again, the market was really caught by this strong employment situation report. We do have geopolitical events, but the market just doesn't seem to be paying attention to that as much. So some comments. The Dow and the S&P did set new all-time highs, while breadth continued to be negative throughout most of the session. So that was a little bit of a contradiction that we saw. Meta was up 20.3%. So if you invest in that, you're probably pretty happy unless you ended up shorting the stock or buying some puts. Amazon was up 7.9%. I think I mentioned Microsoft. I shouldn't have included that in my mentioning. Nvidia was up 5%, but then Apple came out with their earnings and they were down 0.5%, but they had been down as much as 4%, and then they came up off of that. The employment situation report was much stronger than expected, and I have a few charts to go through and show you that. Then looking at the short-term indicators that we have, we're still extreme on a one-day basis. So going from Thursday to Friday, we're looking like we may have overdone it. And we've seen that 2 days in a row. Usually it just pops up for one day and then goes away. We also have the Williams percent R, the CCI and 14 and 20. Those are new additions to the list. The stochastics, the standard deviation, which is another new addition. It had really jetted up to that +3 channel. And the boom indicator is now back on the list as well. Intermediate term, we're still keeping an eye on our different oscillators. We're getting some mixed pictures there as well. And I'll go through and show you the chart on that. The Sean trend meter, the bullish percent index for the NASDAQ 100, where the S&P 500 bullish percent index is now falling. So that's another little negative divergence that we're seeing. The boom indicator, that's what we look at for the 50-period moving average. And then the longer term new high, new low study based on 10 periods for the S&P. We're still looking pretty extreme with our 150 and 200 period simple moving averages in the long term. We're kind of adapting to this little abbreviated scenario that it looks like the Fed is done raising rates. The market was really hoping that maybe it would be in March. Well, that pretty much got wiped out when the Fed Chairperson Powell almost came out and said as much. Now they're looking into May. That's going to adjust as things come out. The employment situation being pretty strong may pump that back even further. So that's the game that the market plays as these economic reports come out here. The dollar was up and interest rates that should have been up right there. We were under 4% after Thursday. After Friday session, we went back up over 4% to 4.03 for the 10-year yield. And we still are watching these yield curves that remain inverted. Sentiment actually came down. We had been at 70 because most of the market was weaker than the handful of stocks. So we actually saw sentiment ticking down. We're still positive at 67. And our trend is still positive, but it's weakening. We're still dropping below the moving averages. So that's not really showing a lot of strength, at least right now, but we are positive because the green line is on top. Our bias is positive with the update, and our momentum is still positive. Here's the economic reports. Non-farm payrolls. They expected 175,000. It came in over double that at 353,000. Just a really big number. And I also included this, which I usually don't include. Last month, we had 216,000. That got revised up over 100,000 to 333,000. So that is looking really strong right now. And that's kind of really raining on the interest rate cut situation because the employment situation is so strong. When we look at non-farm private payrolls, again, this came in over double. They expected 150,000. They actually came in with 317,000. Last time we came out with 164,000. They revised that up to 278,000. The average hourly earnings were double from what was expected. It came in up 0.6%. They expected 0.3%. Last time it was up 0.4%. The unemployment rate was unchanged. They expected it to tick up to 3.8. It stayed at 3.7. We've seen that now for 3 months. And the work week actually ticked down. They expected it to come in at 34.4. It came in at 34.1. Last time it came in at 34.3. Factory orders, a little weaker than expected, up 0.2%. They expected it to be up 0.3%. Last time it was up 2.6%. Consumer sentiment came in a little weaker than expected at 79. They had expected 80. Last time we had the report, it was at 78.8. Here are a few charts. Here's the hourly earnings showing that they are going up, and that could be inflationary. And the market, it's great to be earning more money and everything, but we have to think in terms of the stock market and the economy. When this is starting to go back up, that could really put some pressure on interest rates to go up. And then looking at the payroll changes here, where we were up strong in our latest reading. This is when we take the initial claims that we got on Thursday and the continuing claims, which we also had on Thursday, and the unemployment rate continues to be unchanged at 3.7%. And so we're still kind of flattening out at that level. Still very low historically, but they keep expecting it to go up, but it just doesn't do that. Factory orders ticked down just a little bit, but they are still positive. Durable goods also ticked down, but are still positive. Non-durable goods came up and are just barely above the zero level. And non-defense capital goods on a year-over-year basis did decline, but we're still above zero. Then we look at consumer sentiment, and I have a chart right after this to show you what we look at. When we look at the total chart, that's in blue. It's really hard to see, but we are seeing some improvement. How people are feeling right now, that's the purple line, and then the yellow line is how people are feeling about the future, and we are seeing some improvement there. Here's the chart that we look at, where until Friday session, we had been coming down with the 2-year yield and starting to come back up with how people are feeling about things. So we're seeing this spread between them get less than it was before, but they're still quite far apart from each other based on what we have seen historically. And they do tend to move in the same direction, where interest rates have been coming down and folks have been feeling better about things. That's a little out of line with what we usually see. Here's a couple of Isabel Net blog charts. This is the ISM manufacturing that came out earlier in the week, where we look at the purple line. That's the S&P 500 year over year. And then we look at the ISM manufacturing, which is in yellow, and that is showing some improvement, but it's still below that 50% level. And then this is the earnings sentiment. How are people feeling not only in the US, that's the dark black line, that's the S&P 500, but the stocks 600, that's the lighter blue. They're not really all that optimistic there. The topics, okay, that's the gray line. They're looking a little better. And then emerging markets are also showing a little bit of improvement, but they're still quite negative overall. Just to give you an idea of how things are flowing throughout the whole world. Here's our intraday chart where we did gap higher, and we gave back a lot of the pre-market gains. The futures were up strong, about 0.75% at kind of their high point, and then the report came out, and we came down almost to zero, but then we started to bounce up off of that. By the time the market opened, we did gap higher. We went above R1. We got above R2. We ended up stalling at this 49.75 level before seeing a little bit of selling going into the close. And here's the intraday chart where we were pretty strong. I have to get to the right spot here. We had some earnings come out, and so this really pumped up the futures, which held on to a lot of that. And we were hanging on to these gains, but then the report came out. We came down pretty severely and then started to go back up. And we're trailing off just a little bit as we close for the weekend. We did see where growth, at least the blue line is on top of the red line here, and growth had a much better day than value. So that is more of an improvement. When we look at the next chart, we see that the ratio shows that growth really did outperform. So that is starting to show some more improvement. Again, we want to see if that can continue. Our end of day chart growth was up over 2%, where value ended up being down. And then for the mid caps, growth was up, where for value it was down, and it was down, but it was down less for the small caps. And so we are starting to go back up with our growth to value ratio for the S&P 500. And we're still a little concerned here. This is another negative divergence that we've been watching for a while. Discretionary versus staples, where we look at the ratio, we ticked up just a little bit here, but we're not breaking out the way the S&P has been breaking out. And that has been a concern. Keeping an eye on our trend, we are continuing to decline. We're below the moving average with the intermediate term chart. The green line is still on top though, so we default to positive. Also, kind of chopping right on top of the moving average right now with our short-term ADX, but the green line is going up. We did see volume well above average, so that's been more healthy lately. Keeping an eye on sentiment, we were pretty much flat with the Ulcer Index, but we're still getting pretty low readings overall, showing there's not a lot of fear. We ticked down with the VIX when we look at the line chart as well as the bar chart. We also ticked down when we look at the VIX of the VIX with the bar chart as well as the line chart. And we're continuing to decline with our equity put call ratio. That is declining with the 1-day chart. It continues to decline with the 5-day chart. So that's positive. Here's a chart that we don't look at all that often. We're seeing the correlation between the VIX and the S&P. We're starting to get up to a pretty extreme reading. That's usually negative. We don't know if we've topped out already or if this is still going to go up higher. But once this goes up and starts to come down, quite often that can be negative for the market. We're also keeping an eye on the skew index. This is also anticipating some kind of a big move in the market. We've been in this red area for 3 days now. At some point, we will top out and start to come back down. Is the move going to be up or down? We don't know for sure yet. We'll have to kind of wait until we see that start to happen. But just be aware that this is on the table. Looking at our advanced decline line, didn't really break out all that much based on price with the solid update that we saw. And we are lagging a little bit based on volume. Another little negative divergence. But we did see a real expansion of the new highs. We're turning back up with the 5 period, and we continue to go up with the 10 period. We're above the 0 level and advancing with the advanced decline ratio. Accumulation distribution is also positive. We're showing some improvement here with the Chaikin money flow, and we're turning back up with the Chaikin oscillator. So the smart money is still in there buying. But when you look at the NYSE advanced decline line, it was down where the S&P was up. So that's another negative divergence that we're seeing. We don't know if it's just a 1-day thing or if this is going to develop. There are periods of time when this happens. just be aware that the broader market may start to underperform the big mega cap stocks. And we saw that a lot in 2023, and it still helped the indexes to go higher. Then I wanted to show this as well. This is the cumulative NYSE advanced decline line where we were actually down, both with the cumulative measure and with the regular advanced decline line. We were not showing really any strength there. So we were coming down with the NYSE based on common stock. We were flat with the S&P. We declined with the mid caps, and we're back down to the moving average after declining with the small caps. And here's our chart. We're coming right up to this pivot point now. So this is still looking healthy when you just take all the bars. Then on the bottom, you see where we were above average with volume. And here's our 1-day rate of change. We have now spent 2 days after being extreme positive. We went extreme negative, and now we spent the last 2 days being extreme positive. Very interesting. The Williams percent R is continuing to go back and look extreme positive. The CCI 14 and the CCI 20 are also getting extreme positive. We actually turned down with our 20, 50, and 200-day moving average study. That's showing that was not an awful lot of strength inside the S&P. The force index is still looking good. We've been able to come back above the midpoint, and as long as we stay above that, the midpoint will begin to turn back up. We're still extreme with the stochastics in the short, intermediate, and long term, even though we're declining in the intermediate term. We're pretty much flat in the long term. We're up into the +3 standard deviations now. So that's suggesting that we kind of overdid it between Thursday and Friday. Some intermediate term charts, we're still positive with the balance of power. We're positive with the go, no-go system. We're positive with the highest high value. We're positive with the TTM squeeze. And this is like off the charts when we look at the 1-day ease of movement, but we are starting to turn back up with our 14 period. So that is positive. And we ticked up slightly, showing that buyers are starting to come back in with the Erin indicator and sellers are decreasing. So that's why our oscillator is above zero and advancing. This is another negative divergence. Had a solid up day with the S&P. We're actually declining and below zero with the McClellan oscillator. So we're starting to decline and continuing to decline here based on price, but we're still going up based on volume. We're seeing a little bit of a contradiction here. We're also negative with the NYSE McClellan oscillator. We dropped back below zero. So we're flattening out for right now with the summation index for the NYSE. Based on price, we are declining looking at volume. And we're declining with the Swenlin trading oscillator, both based on price and volume, but both are still above zero. And we're just kind of chopping around sideways with the PMO. We're still negative based on price, and we're right on top of the moving average based on volume. We ticked down slightly with the PMOs that are rising. We're ticked up just a little bit with the buy signals. We're still just barely extreme positive with the PMOs that are above zero. We've gone from being neutral over to positive with the Elder's Impulse system for the S&P. We're still positive here with the parabolic SAR with the dots underneath. And we're coming down, but we're still above the moving average with the slope oscillator. And we're turning back up now above the moving average with the MACD. So we're kind of coming down a little bit here with the slope. We're right on the moving average with the TSI. So short term, we're seeing some contradiction. We're going back up with the MACD. We're on the moving average, but showing a little bit of improvement with the PMO. And we're still kind of coming down here with the PPO. We continue to be positive with our longer term KST and TRIX oscillators. And we're still above all of the plotted moving averages in our moving average tree. Even on an update, we saw the bullish percent index decline. That's another negative divergence to be aware of. We also declined with the NYSE bullish percent index, but we're still above 50. We declined with the NASDAQ 100 bullish percent index. Okay, another negative divergence, and we're also still extreme here. And the money flow is still looking okay and not giving us an extreme positive reading. We're looking positive here with the ultimate oscillator. We're going back up with the vortex. We're not extreme, but we did show some improvement with the RSI based on 14 as well as 9 periods. We're still above the advancing moving average with on balance volume. We actually turned down with the 200-day moving average study for the S&P, and we also declined with the 50 period, another negative divergence. We're still looking okay when we look at the Copic curve. That's positive, and we're going back up and almost extreme, but not really extreme with the Shaw trend meter. We're getting a pretty high reading with the boom indicator. That measures how far away are we from the 20-period moving average. We're also getting an extreme reading saying that we're far away from the 50-period moving average, and we're still showing some improvement here with the 200-period moving average. With our charts, the Heiken Ashi is now switched back to positive. So it had been negative for a couple of days and it's showing some improvement. We're also looking positive with the Kegi chart. The Renko chart is redrawn and is looking more positive. The 3-line break is also showing some improvement and turning back positive. Long term, we're still extreme with the 150 and 200 period simple moving averages. Our different indexes, we were up kind of here with the equal weight, but it did underperform in Friday's session. And then when we look at the ratio, we really went up, showing that the mega caps outperformed. And I'm dropping the Dow transports for right now, that those charts showing the negative divergences. That's been going on for so long. I'm just repeating myself. I look at those charts every day. I will show them in the weekly video. And if they start to really make some noise, I'll put them back in the video to show you those. With the Dow, we did have another up day, setting a new all-time high. The diamonds have switched, well, they did switch back over to positive, and they continue to be positive. We're still looking okay with the NASDAQ. We are underneath this pivot level at R1 here. Is that going to cause some problems? And we're still in no man's land, but showing some improvement when we look at the Fibonacci charts for the NASDAQ. We did go up with the NASDAQ 100. We also have overhead resistance, which is more shorter term. And we've switched from being neutral back over to positive for the QQQs. We're still on top of the moving average of the PPO. We are improving, but we haven't really crossed back above the moving average yet after we had crossed negative. The small caps, they were down about 0.5%, down below this pivot level, and coming back down, at least on an intraday basis, back down to their 50-day moving average. And they've gone from being neutral back over to negative. When we look at the Elder's Impulse system, we're still below this resistance level here. It looked like there was some hope as we were getting above it. We've now spent the last 3 trading days below this resistance level. And as I said, we're kind of battling with this 50-period moving average, at least on an intraday basis. We're still looking negative with momentum, and we're crossing back below 50 with the RSI. The mid caps, also staying above this pivot level for right now. So they're holding up a little bit better. They still continue to be positive with the Elder's Impulse system. And the FANG index, not any real surprise there, set another new all-time high. Financial sector was up less than 0.5%, but it's still looking good for right now. The dollar is starting to rebound even a little bit more, back up into the high 103 range, but we're still in a longer-term downtrend. We went back up with the 10-year yield. We came down with the 10-year based on price. And then looking at our growth to value, we turned up just a little bit with the Qs to S&P. We're showing a little bit of an improvement here with discretionary to S&P, but we're still below a declining moving average. We are seeing large cap growth outperform large cap value. We saw some improvements with the large caps, mid caps, and even a little more pronounced improvement with the small caps, even though we didn't see that in the index. We're still extreme positive with our 10-day average of the S&P 500 highs minus the lows. We've been that way for all of 2024. We're still positive with our 5-period highs minus lows moving average study when we look at the broad market. So what's our outlook for Monday? The technicals, we're positive, we're overbought. We're watching these negative divergences and wondering, is weakness starting to develop? We'll get the S&P Global U.S. Services PMI final reading, and we're going to get the big one will be the ISM non-manufacturing PMI. And then we're watching all these different geopolitical things. There is some escalation that I'm hearing about as I went to record this. It's developing in the Middle East. We'll see if that ends up having any kind of an impact on oil or gold or the dollar. And then that can often come through and have an impact on stocks. Here's the upcoming economic calendar, where we're not going to get any reports on Tuesday. It's kind of a light week. We're just going to get some other token type economic reports. We still want to pay attention to these, but there's not the really big major ones that we had. We're also not going to have any reports coming out this coming Friday. Seasonally, and I've tried to pare down a few of the charts here. When we just look at February 5th, we're neutral to negative with the Dow, and we're just flat out negative with the S&P and NASDAQ. So seasonally, we do see some weakness. I'm still showing this chart for right now, where when we have an up January, that tends to bode well for the year. Also, it's looking like we're still hanging in there seasonally with looking more positive. And then we do see some weakness in the latter part of February going into about the middle part or so of March. And we're looking a little better as we get into February when the sitting president is running for re-election. But we do top out either in the first third to half of the month before we see some weakness after that can take us down into about the middle part of March. So seasonally, just be aware of that. Monday session tends to be the most positive day of the week. So even historically, we're looking at seasonal weakness, but when we look at 2023, it was the most positive day of the week. We will be on the third trading day where we do see a little bit of weakness during an election year. That's the green dashed line for the S&P. So our scenarios, not going with the down one, even though we are seeing some negative divergences, we are going with this idea. Is weakness starting to develop here? We have to go with the up one because the charts are going up, at least when you're looking at the S&P, but be aware that it is overbought and there could be some weakness developing. We're not going with the sideways for right now. Our ADX indicators are showing weakness, but they're still above 20. So that doesn't suggest that we're in a trendless environment. The warning signs, the risk on, it really hasn't done any good for us the last few weeks. The McClellan oscillators and the summation index are negatively diverging when you look at the S&P. We're seeing a bit of that carry over into the NASDAQ 100 as well as, not the NASDAQ 100, but the NYSE. The S&P NASDAQ 100 is declining after being extreme. Okay, that doesn't make sense. This should be the S&P BPI, bullish percent index, is declining after it had been extreme. The transports continue to negatively diverge from the Dow. The NASDAQ 100 PPO, it's right on top of its moving average. So it was turning negative. Now it's starting to show some improvement. The positive signs, we are seeing some improvement in growth. The equity put call ratio based on 5 periods is going down. We're mixed when we look at our oscillators. We're seeing some contradiction there. We're looking a little more negative in the short term. We're more mixed in the intermediate term, where we're still positive in the long term. The parabolic SAR and vortex charts are still positive. The bullish percent index, this is what it should have been. It's still extreme positive, but it is positive. The Copic curve is positive. We saw a nice little bump up with small cap growth, but we're just getting more to the high end of the range that we've been in. We didn't really see much follow through with mid cap growth. We're still positive there, but more or less chopping sideways, and the financial sector continues to be positive. So our conclusion, we're still positive. We're still overbought. We're still wondering, is more weakness going to develop? In the short term, we're saying that same thing. We're more overbought in the intermediate term, but if these negative divergences beyond what we've already been talking about, if they start to show up more prevalent in the S&P, then that could suggest some weaknesses developing there as well. We're still positive in the long term, even though the longer term moving averages are still extreme. Thank you. I really hope you found this helpful. I will be posting the weekly video, the intermarket analysis video, and the deep dive video over the weekend. So I do hope you have a great weekend, and I will talk to you in the next video.